macro currency signals.
You are not watching a normal market move. You are watching a structural event. And most people have no idea it has already begun. If you are staring at the price chart alone, you are missing the story. Price is the distraction. Delivery is the signal. And what is happening inside the delivery mechanism right now is something that almost never happens in modern financial history. For decades, the futures market functioned as a pricing machine. Contracts were paper. Exposure was synthetic. Less than a sliver of total contracts ever converted into physical metal. It was a game of leverage, not logistics. A hedging venue, not a distribution center. Paper in, paper out. Cash settled, clean, predictable, controlled. That era is ending. Month after month, contracts are not being rolled. They are being stood for delivery, converted, claimed, removed from circulation. What used to be a statistical rounding error has become a recurring event. Not once, not twice, repeatedly. When that behavior changes, the character of the market changes. Before we push further, if this analysis is connecting with you, make sure you're subscribed and notifications are switched on. In markets like this, timing isn't just helpful, it's the advantage. Being early rarely feels comfortable. It rarely feels validated, but that's where true leverage is built. Leave a comment below and share where you're watching from and the time in your corner of the world. This isn't confined to one nation, one currency, or one exchange. It's a global shift. And when you see how far this message travels, you realize it's larger than any single news cycle. Now, let's step back into what's quietly unfolding beneath the surface. Think about the scale. Tens of millions of ounces in a single month. Not retail coin buyers, not social media campaigns. Industrial scale acquisition. Commercial scale withdrawal, metal that leaves the active supply pool and does not return. When contracts move into physical settlement and then into categories that indicate they are no longer for sale, that is not speculation, that is repositioning. And it is happening quietly. The mainstream narrative has not caught up because the mainstream narrative depends on price. If price spikes dramatically, it becomes news. If structure shifts slowly and relentlessly, it is ignored until it is too late. This is not about one delivery month. This is about consistency, persistence, acceleration. The futures exchange was designed around the assumption that very few participants would ever demand physical metal. That assumption created efficiency. It allowed leverage. It allowed liquidity to appear larger than the underlying physical base. But when a rising percentage of participants start choosing metal over cash, the math changes. Not because there is zero metal, but because the margin for error shrinks. Liquidity is not the same as supply. Liquidity is the willingness to transact. Supply is the metal itself. When metal migrates into strong hands, liquidity tightens even if global mine production has not collapsed. And when liquidity tightens, volatility rises. Now add geopolitics. The global refining network is concentrated. A majority of raw material passes through a small number of jurisdictions before being converted into investment-grade bars. That concentration worked beautifully in a stable geopolitical environment. It does not work the same way in a world prioritizing national security. When governments begin labeling materials as strategic, when export licenses tighten, when domestic allocation takes precedence over global trade, the smooth pipeline fractures. Markets can tolerate high prices. They struggle with interrupted flow. Flow disruption creates premiums. Premiums create urgency. Urgency creates hoarding. Hoarding accelerates the very tightness that caused it. This is how structural squeezes begin. Not through panic, but through friction. And friction is building. Investment-grade bars that were once the most boring, abundant products on Earth are becoming harder to source. Import hesitation, licensing uncertainty, tariff threats, refinery bottlenecks, each factor small on its own. Together, meaningful. Now ask yourself something important. Why is this happening before mainstream participation? There is no mass retail frenzy yet. No front-page hysteria, no universal euphoria. This repositioning is happening at a level above headlines. And that is what makes it significant. Because historically, by the time retail enthusiasm arrives, the structural move has already advanced. We also need to address leverage, because this is where myths cloud judgment. Yes, futures markets operate on leverage. Yes, banks hedge exposure. But catastrophic collapse does not require absurd leverage ratios. It requires persistent drawdown combined with reduced flexibility. When inventory buffers shrink, optionality shrinks. When optionality shrinks, stability weakens. The issue is not whether someone is 100-to-1 leveraged. The issue is whether the system can comfortably accommodate repeated physical withdrawals without price adjustment. If delivery remains elevated month after month, the cushion thins, not instantly, gradually. And gradual pressure is more dangerous than sudden shock because it lulls observers into complacency. Now zoom out even further. Critical mineral designations, strategic stockpiling, currency blocks forming alternative settlement pathways, debt levels stretching beyond historical norms, central banks accumulating monetary metals at record pace. These are not isolated phenomena. They are signals of reprioritization. When sovereign actors accumulate monetary assets consistently, it is not trend following, it is policy. And policy shifts ripple outward. Gold tends to move first in monetary transitions. Silver often lags until it accelerates, because silver is dual-natured: monetary history, industrial necessity, strategic metal. When monetary stress collides with industrial demand, the move is not linear. And here's the key point most people miss. This does not require panic, it requires positioning. Markets do not reprice because of one dramatic headline. They reprice because behavior shifts underneath the surface. Repeated deliveries, export prioritization, shrinking liquidity buffers, inventory migration, premium expansion, strategic designation, individually, manageable, collectively, transformative, and once transformation begins, the old correlation frameworks start breaking down. What worked for decades stops working. Traditional seasonality loses predictive power. Paper pricing mechanisms lose dominance. Physical assertion increases influence. You are watching the early stages of that reset. Does that mean straight up forever? No. Volatility will intensify. Sharp corrections will appear. Engineered sell-offs may occur. Margin adjustments may return. But when structural tightness underlies price, dips behave differently. They get absorbed because the underlying behavior has changed. And this is the word that matters most. Behavior. Markets are psychology layered on logistics, layered on leverage. When psychology shifts, logistics tighten, and leverage compresses simultaneously, liquidity events occur, not necessarily crashes. Liquidity events. Moments where price must adjust to reflect reduced flexibility. We are approaching that threshold, not because of conspiracy, not because of myth, because delivery data and supply flow patterns are telling a story that price has not fully priced in yet. And when price finally catches up to structure, it does not whisper, it moves, suddenly, violently, decisively. This is not about chasing numbers, it is about recognizing that the plumbing of the system is changing, the quiet migration from paper to physical, the silent reprioritization of sovereign stockpiles, the subtle tightening of export channels, the creeping scarcity of once abundant formats. These are not emotional signals, they are mechanical ones, and mechanical pressure builds until it releases. The biggest liquidity events in history rarely announce themselves in advance. They start with anomalies, they continue with repetition, they accelerate with friction, and by the time headlines acknowledge them, positioning windows have narrowed. Right now, the window is still open, but it is not as wide as it was. And if the current delivery trend continues, if export restrictions persist, if strategic accumulation remains consistent, then the system will have to adapt. Adaptation in markets means repricing. Repricing in tight markets means volatility. Volatility in strategic metals means attention. And attention is what ultimately brings participation. When participation arrives, it amplifies what structure already set in motion. That is how liquidity events become historic. You are not witnessing noise, you are witnessing transition, and transitions are rarely comfortable, but they are always consequential. Liquidity compression does not start with collapse. It starts with subtle imbalance. At first, it looks manageable. Inventories still appear adequate. Charts still oscillate. Commentators still debate whether metals are overbought or oversold. But underneath that surface, something critical begins to happen. The ratio between available metal and claims on that metal tightens. And that ratio is everything. For decades, the future structure operated smoothly because confidence outweighed conversion. Participants were comfortable holding exposure rather than demanding settlement. That comfort created elasticity. It allowed the paper market to be larger than the physical market without consequence. But elasticity disappears when confidence shifts toward possession. When more participants choose metal over cash, the elasticity that once absorbed volatility begins to contract. That contraction is not visible on the daily price candle. It is visible in delivery trends. It is visible in category migration, registered into eligible into private vaults into strategic holdings. And when metal leaves the active circulation pool, it does not contribute to daily liquidity anymore. This is where the word event becomes relevant. An event is not a headline. An event is a threshold being crossed. Right now, Thresholds are being tested. Consider what happens when physical inventory becomes increasingly sticky. Sticky inventory does not respond quickly to price declines. It does not flood back into the market at the first sign of weakness. It sits. That reduces float. Reduced float increases price sensitivity. Increased price sensitivity means smaller imbalances create larger moves. This is how liquidity events amplify. Now layer in monetary stress. Global debt levels are not normal. Currency confidence cycles are not stable. Sovereign fiscal pressure is not easing. When debt expansion collides with inflation sensitivity, policymakers are forced into difficult trade-offs. And difficult trade-offs increase uncertainty. Uncertainty drives reserve diversification. Reserve diversification drives metal accumulation. Metal accumulation drains float. Drain float long enough, and you create structural repricing pressure. This is not about fear. It is about math. If industrial demand remains steady or grows, if sovereign accumulation persists, and if investment demand reawakens simultaneously, the system must choose between two outcomes: price adjustment or physical tightness. Historically, price adjusts first. But price only adjusts once pressure becomes undeniable, and pressure builds quietly. There's another layer here that most overlook: correlation reset. For years, metals were treated as secondary hedges, reacting to currency moves and real rates in predictable patterns. When rates rose, metals softened. When the dollar strengthened, metals retreated. That framework worked in a relatively stable financial regime, but when structural demand shifts, correlations destabilize. You may already be noticing that certain traditional relationships feel less reliable. That is not randomness. That is transition. When an asset class moves from speculative hedge to strategic asset, its beta shifts. It becomes less reactive and more autonomous. It trades less like a derivative of policy and more like a policy signal itself. Gold began that process earlier. Silver, because of its hybrid industrial monetary nature, often lags the recognition phase. But when it moves with torque. Torque is what defines late-stage liquidity compression. Torque is violent repricing when positioning is misaligned with structure. Right now, positioning in broad financial markets still assumes abundant liquidity. It still assumes smooth settlement. It still assumes that delivery surges are temporary anomalies. But anomalies that repeat are not anomalies. They are patterns. Patterns that persist redefine baselines. Now think about refining concentration and export prioritization again, not as isolated policy decisions, but as structural choke points. When a large portion of global refining capacity sits within jurisdictions prioritizing domestic allocation, the optionality of the global market shrinks. Optionality is what keeps spreads tight and premiums low. Shrink optionality and spreads widen. Widen spreads and arbitrage weakens. Weaken arbitrage and regional shortages appear even if global supply looks adequate on paper. Regional shortages fuel panic narratives. Panic narratives accelerate retail demand. Retail demand colliding with already tight float accelerates volatility. This is the chain reaction. And here is the most important point of this entire discussion. This process does not require collapse to be historic. It only requires repricing. Historic liquidity events are not always crashes downward. Sometimes they are upward repricings that permanently shift valuation bands. If silver redefines its equilibrium price because physical assertion overpowers paper dominance, that is a liquidity event. If futures pricing loses some influence to physical premiums, that is a liquidity event. If sovereign stockpiling reduces the metal available for financial arbitrage, that is a liquidity event. The scale does not need to resemble past speculative manias to be historic. It simply needs to mark a regime change. And regime changes are uncomfortable because old models stop working. Investors trained on decades of behavior expect retracements to reset markets. They expect supply to reappear. They expect paper pressure to cap rallies indefinitely. But those expectations depend on elastic liquidity. If elasticity is shrinking, so is the reliability of those assumptions. This is why corrections in structurally tight markets often feel confusing. They arrive sharply. They shake out weak hands. And then they reverse with surprising speed because underlying demand did not disappear. Strong hands do not liquidate easily, and strong hands are accumulating. Now let's address the psychology of disbelief. Whenever structural change begins, the dominant response is dismissal. It has happened before. It will revert. It is just seasonality. It is just speculative excess. Dismissal is comforting because it preserves mental models. But structural shifts ignore comfort. The data does not care about narrative convenience. If delivery remains elevated across multiple cycles, if export controls persist, if sovereign allocation increases, if physical premiums widen despite corrections, then the narrative must adapt, or it will be left behind. You are living through a monetary rebalancing era. It may take years to fully express. It may unfold in waves. But the foundation is being laid now. Repeated physical conversion, strategic classification, export prioritization, inventory migration, correlation breakdown. These are early stage signals. When enough early stage signals cluster together, probability shifts. Probability does not guarantee outcome, but it changes risk profiles. And ignoring changing risk profiles is how historic events surprise people. There is one more dynamic that must be understood: velocity of information versus velocity of metal. Information moves instantly. Metal does not. In past decades, rapid information flow could suppress price quickly because most participants held paper claims. Selling pressure could cascade without requiring logistics. But when physical ownership increases, information velocity cannot force metal to move as easily. You can panic sell a contract in milliseconds. You cannot panic export a vaulted bar instantly. That lag matters because it reduces the speed at which selling pressure can overwhelm structure. It does not eliminate volatility, it alters its character. Volatility becomes more explosive when it does occur because float is thinner. This is why liquidity compression events are rarely gradual once ignition begins. They simmer, they tighten, they frustrate participants, and then they accelerate. When acceleration begins, price targets that once seemed extreme begin to look mechanical. Measured moves become magnets, breakouts become self-reinforcing. Because repricing is not emotional, it is structural correction. And structural corrections do not ask permission. Right now, the system is being stress tested, not by retail traders, not by viral campaigns, but by persistent demand for physical settlement in a market that historically depended on cash settlement. That distinction is enormous because it transforms the exchange from a pricing venue into a delivery venue. And delivery venues cannot operate indefinitely on the assumption that very few will demand delivery. If that assumption continues to weaken, the exchange must adapt. Adaptation may come in the form of higher margins, higher prices, reduced leverage, or shifts in contract structure. All of those are manifestations of tightening, and tightening is the precondition for historic liquidity events. This is why calling this just another rally misses the point. This is about plumbing. The plumbing is shifting. And when plumbing shifts in financial systems, price follows. Not because of hype, not because of emotion, but because the mechanism itself demands recalibration. You are witnessing recalibration begin. Whether it becomes explosive depends on continuation. If deliveries normalize, pressure eases. If they persist or accelerate, pressure compounds. And compounded pressure eventually forces repricing. That repricing is what could define this era. The biggest liquidity events in history were rarely understood in real time. They were recognized afterward. When analysts look back and said, the signals were there. The signals are here now. The question is whether you recognize them before the rest of the market does. This is not noise. It is not hype. It is not another short-term spike to be forgotten in a few months. It is a structural shift unfolding in real time. When paper converts to physical at scale, when export channels tighten, when strategic metals are reprioritized, when liquidity slowly compresses beneath a calm surface, history is being written. The biggest liquidity events do not begin with explosions. They begin with quiet withdrawals, subtle friction, and repeated behavior changes that most people dismiss. And then, one day, price catches up to structure. When that moment arrives, it will not ask for permission. It will not wait for consensus. It will move with force. The only question is whether you recognize the transition while it was still forming, or whether you waited until the emergency was obvious to everyone.